Welcome to the REI Foundation podcast, where we cover all the steps and strategies to make your real estate dreams a reality. Now your hosts, Jason and Pili.
Well, hello again, and welcome to another edition of the Real Estate Investing Foundation podcast with Jason and Pili. We are super excited for today's show. We have an awesome guest, Bernard Reisz. Hey, Bernard, how you doing?
Doing great. Excited to be on the show and looking forward to sharing empowering knowledge.
Good. Well, we are excited for today's topics. It's stuff that we haven't done before. After 300 and I think about 10 episodes, we're going to focus on a topic that we haven't brought to you, and that always excites us. But before we jump into that, a little more about Bernard. Bernard Reisz CPA empowers individuals to optimize their finances using proactive and innovative strategies. He provides an integrated approach to tax and financial planning for real estate pros, focusing on their unique profiles and opportunities. Bernard is also the founder of 401kcheckbook.com, which gives investors direct control of their tax-sheltered funds for real estate equity and debt opportunities using Checkbook Control IRAs, solo 401ks, and Checkbook Life Insurance. And he's also the founder of agentfinancial.com, which provides tax, entity, and financial services to real estate professionals, including real estate agents, investors, and mortgage brokers. So prior to founding ReSure, Bernard served as director of CoMetrics Partners, managing an array of engagements involving financial consultant and due diligence. And he advised owners of closely held middle market companies on advanced tax mitigation strategies. Well, noting, Bernard, that we are going to touch on due diligence for basically all things tax related today, I think we're in very good hands with you. So if I've missed anything there, why don't you give us a quick overview of what you're doing now, and then let's dive in.
Yes. So right now, focus on, providing integrated advice, which means to say when people get involved in anything financial or tax related, it requires expertise in all related, financial disciplines. In general, when people go to a life insurance agent, they'll get one perspective. CPA, they'll get a second perspective, an attorney, a third perspective, financial advisor, yet a fourth perspective. And if you'd ask me, I'd say none of those perspectives is actually the correct one. It's not like you got to choose one of the four. The objective truth for any individual is going to be some blend of the four. And the challenge is, well, how do you navigate that? You're not you need to be able to interact with somebody that's got a solid grasp of every one of those areas. So in my background, I am a CPA. I also hold securities and insurance licenses. And as part of advising owners of closely held companies, all those things came together. So kind of being the point person for due diligence, for tax strategy, for accounting related things. So we got to see both advise and also get incredible insight into those providers, the people that provide that kind of fragmented perspective. We'll see what those attorney, may encourage, what that life insurance agent will encourage, financial advisor, and there are always so many different strategies. And you're only going to get the objective and optimal outcome if you deal with somebody that knows all of those things and is able to integrate them. So that is what I focus on today.
Awesome. And now, since our main engagement is real estate, let's dive in. Let's talk about real estate opportunities. And as a real estate investors, new and seasoned, they have to structure themselves to act accordingly within their businesses based on the opportunities that they're going after. So can you touch a little bit just on a point of, if there's an investor here today that maybe is just starting out in their journey, what are some of the items from a due diligence standpoint they should think about when preparing to build a business as a real estate investor, agent, or other?
Yes. So it will depend on, what their profile is, but when there are certain concepts that they're looking to address from the get-go. So obviously they're looking to get their legal and tax structure in place. And I'd say there's an initial, from my perspective, there's an initial structure that you need, and then that structure has to evolve. And then there's the actual investment side. What's at the core of everything has got to be something that's going to generate profitable income. And that's a mistake that we see people doing all the time. They get so focused on what I'd call that legal and tax stuff, which again is a key component of long-term success. But it's more, I view that just as an envelope, right? When you have got an envelope, the important thing is really what goes inside. And what goes inside there is, what's your business model? What's your value proposition? What are you going to be doing? And then once you identify that, you build your structure around that. Too often people are focusing on their legal and entity structure and not focusing enough on the core business. And I think there are a couple of factors that contribute to that. Developing a business is something that's hard to do. You've got to do the legwork yourself. It's going to be your business. Setting up legal entities, you can do that. That's easy. And there are enough people that are there to set things up for you and offer you structures. And people kind of get their focus on the easy side of things. And this way they kind of feel they're making progress. Oh, we're doing something. I'm starting my business. But they're starting a legal structure. They haven't started their business. First thing is identify your business model and then build the legal and tax structure around that. And one way that and on that note, I see people getting involved in structures that I think are really not optimal. They're getting things from internet-based gurus that are pitching things. They're paying incredible amounts of money to get a structure that is not well matched to where they're at. May not even be suboptimal. You know, I'd say that I deal with clients from a broad spectrum across the country. And you'd be amazed how many people that I have to deal with. They're 3 years in and they're like, Bernard, okay, I've got this structure, Nevada LLC with an S corporation and a Delaware trust. And this structure cost me $10,000 to set up, a couple of grand a year to maintain. And I'm like, okay, and how much income are you generating? And they're nowhere in their actual revenue generation, and they've got this structure in place. So I think people really got to think ahead, get an initial structure at the beginning, use the KISS method, keep it simple, and have a structure that evolves. Have you seen any of the same thing? Do you see this as well?
Yeah, and you can think of a million different proponents, right, where people say, I'm about to get starting in real estate investing, but I just need to get my LLC set up first. And
yeah.
Approach. So, okay, so we've gone down that rabbit hole, right? So when should I engage that entity? Because now I'm going to focus on my business, right? I'm going to get out there and get active and say, for simplicity, we'll talk, I'm a house flipper. Let's just say I'm a house flipper for an example. So for any house flipper out there, we're going to go down your path here. I'm a house flipper. I'm out there looking to do my first deal. I find a property, I start making offers, and maybe I get an offer accepted. At what point am I setting up an LLC?
Yes. So an LLC an LLC in itself is very simple. It's a simple entity, and I always encourage that they be used. And you should get that up as soon as you identify a deal, or even prior to that. If you've identified your market, you know where your market's going to be, get the entity set up. Because a simple LLC is not costly or time consuming, and you want that to be in place so you can move quickly. When you start running into trouble is when you don't know your market yet, or you don't know your business. So it comes back to that. Don't do anything until you've identified your business model. But once you've identified your business model and you have a market, set up that LLC. Because when you identify a deal and you've got to close, and then timing is crucial, you want that in place. And the key thing to be aware of is asset protection is a local game. It's state-driven. It's not driven by federal law. So you don't want a deal, and ideally, if you're going to have an asset in New York, you want a New York LLC. You can have a Nevada LLC registered in New York, but why would you do that? New York is going to follow New York law. They're not going to follow Nevada law. So one of I'd say a red flags when you're dealing with this entity structuring stuff is if people are doing, if they say Nevada, that's a general red flag. And if they say you're going to have tax benefits by having your entity in Nevada, that's just so wrong. Nevada is an expensive state just to have an LLC in. your LLC expense cost for being in Nevada is relatively high, and your asset's going to be in New York. So you're going to have to either register that Nevada LLC in New York and pay New York on top of paying Nevada, and your taxes are going to be wherever the asset is. So you're going to pay New York tax on any New York deal or New York asset that you have. Nevada plays no role other than the fact that they get to collect between them and their service providers. You're going to be shelling out about $1,000 per year. Other than that, it's completely immaterial. So in general, get the entity set up in the state that you're in. If you see somebody hawking stuff, podcasts over the internet, we've got this structure, Texas Series LLC, stay away, because it's a Texas Series LLC, works in Texas. New York is not under any obligation to follow Texas law. And if you've got an asset in New York and there's this lawsuit, it's going to be adjudicated in New York. And New York, a New York judge has no New York law or statute that he has to follow with regard to Series LLC. He has no case law. He has no precedent. So he could choose to honor the Texas statute, but who knows? There's no history there. You're kind of rolling the dice, and rolling the dice is the opposite of asset protection.
Huh. So that leads to a great point here, right? And so we're talking about asset protection. So, we have our LLCs for our different asset or investment vehicles. Well, how protected am I? And let's talk about, you hear a lot about piercing the corporate veil, right? And so let's think of an example. Say you're doing a flip on a property and something goes awry. Someone comes and trips and falls, and although it should be covered under insurance and you have insurance, they try and sue the LLC, and then they try and sue you personally. Well, how protected am I with the LLC set up?
Yeah, a great question. And it's good to say that with regard to anything asset protection related, nothing is bulletproof. And so if anybody tells you they've got the bulletproof structure, that's just marketing hyperbole. It's not, nothing is bulletproof, but it's about optimizing your structure so as to perhaps deter forcing a settlement and getting you positioned for the best outcome. But nothing is bulletproof. So it's important to understand that there are distinctions among within state law about the level of protection that different LLCs will provide. And there are two sources of liability that you're looking to protect from. So there is a liability flowing the way that you referred to, which is something happens on the property. And then they want to go after you based on what happened at the property. Then you've got liability flowing the other way. That's what we called outside liability, which is say that the owner of the property, the owner of the asset, the owner of the LLC personally harmed somebody. He's got some sort of tortious event. He personally injures somebody and they want to go after him and get his assets. So it flows both ways. So those are referred to as inside liability. That's liability coming from the asset that may be within the LLC, within the entity. And then there's outside liability, which is liability flowing from the LLC owner to the assets within the LLC. So if you've got something that happens within the LLC, it's important to distinguish between two potential sources of liability. If it's something that's strictly related to the asset, then you have stronger protections in place. Of course, they're always going to go after anybody. They're going to try to throw they're going to swing at anything that moves. So they're going to, of course, name the LLC. They're going to name you personally as a co-defendant. But if you've got an LLC, the asset's an LLC, but you personally directly contributed to the injury, to the event, then the LLC is not really much of protection because that was you, it wasn't the asset. So many professionals, for example, an LLC doesn't offer that much protection because they're providing a personal service and it's them providing the service. It's not directly related to some asset. So they have much limited protection. So you want to, if you're having something going on in the asset, you generally want to you're hoping that's something that they can't trace to you directly, something that happened to the asset, and then they'll have a harder time going after your personal assets. but whatever is within the LLC is fair game. And let me elaborate on that just a bit. I've encountered people that say, yeah, I've got great asset protection in place. I've got 15 rental properties and they're all in an LLC. So like, okay, if you've got all your assets in a single LLC, you've got no asset protection. Because the concept is, it's when you talk about asset protection, you're really talking about segregation of liabilities. It's about putting up a fence, a wall between your assets. So if you own them all in your personal name, right? So something happens to you, right? You're liable, then go after all your assets. When you create an entity, a statutory entity, such as a corporation or an LLC, that's like a legal person. And the idea is, well, they can sue that person and they can go after all the assets of that legal person. And that legal person only holds property A. If that legal person owns properties A through Z, well, they can go after all those properties. So you're looking to have limited assets within each legal entity so that there's a wall between your assets. So if something happens to asset one, there's a trip and fall there, well, they're going to go after that LLC, which owns asset one, but asset two is owned by LLC two, which is a separate person. So it cannot get pulled in to that lawsuit. So you're looking to have the segregation of liabilities. I know it's a lot of information. So what do you, and any questions?
Good. Very good information, right? Because I have heard that a lot, right? So people are like, well, I have one LLC for all the flips I'm doing, and one LLC for all the the buy and holds I'm doing, and I have 20 properties in this LLC or 15 properties in that LLC. Well, is there some good rule of thumb? Should I have a different asset protection for every asset I have? Excuse me, I have my bulldogs at the office today, so they're
there's no
a bit here. So, but is there a certain rule of thumb? Can I keep each LLC to 3 properties, or should I have literally each specific LLC should have its own property?
So there are a couple of moving parts here, but even after we address all those, it comes down to a matter of personal risk tolerance, preference, and your personal approach. So the other things you got to think about are, what are the value of each asset? So it's not so much about the number of assets, it's about what's the value of the asset, right? If you're the value of each of your properties, if you're going is $50,000, so you think, okay, I'm ready to have $100,000 of exposure within each particular LLC. Well, then you can have 2 assets in there. But for if you've got another property that's $100,000 worth, you want to put that asset in its own LLC. So it's not so much the number of properties; it's more about what's the value, what's your gross, cumulative exposure with among those assets. That's one point. The second thing is, well, what kind of liabilities do you have in those assets, right? So if you've got $1 million asset, but it's mortgaged to the bank, and the bank, is entitled to, $800,000 of debt on it. Well, you don't have that. You may not have that much, non-recourse debt on it. Then you may not have that much exposure because the total equity is relatively low. So the asset may have a certain value, but your equity, your total exposure, your net exposure is far less than the asset value. And then on top of that, you got to think about, all right, obviously you've got insurance in place. So what are your insurance limits? Do you have umbrella insurance? So there are multiple moving parts and that will be determined by every individual's profile.
Amazing. Now, on that topic here, let's think of our direction here. So we have that part. Let's transition a bit to passive investments, because we spoke a bit on active, but as a passive investor, if, say, syndications, so we'll jump into that field. If there is a syndication I think I want to invest in as a passive investor, and I don't want to talk about investment side, because you could do it, as your IRA, or however you want to do it into that. But is there a point, if I was going to invest in an LLC, I'd be safer to do this in an LLC instead of my personal name?
So with a syndication, the syndication itself is already going to be an LLC. Is there some added value by holding your interest through an additional LLC? There's always some marginal benefit, but overall, not much benefit there because already is held in an LLC, and that LLC is a partnership. Ideally, there are certain benefits. It's good to move over to talk about the outside liability. So when it comes to outside liability, your key protection, it comes from something called charging order protections. Have you ever heard the term charging order?
I have not. Please go into it.
So the concept is that when you've got outside liability, so say you've got your asset in an LLC, so there's a measure of protection there. If something happens with the property, they can't go after you personally because the property is held in an LLC. But say you're involved in a auto accident, and now they want to go after you, and they want to, they got a judgment. They want to satisfy that judgment with your assets. Well, you own a property. You may not own it directly, right? But you own the LLC, which owns the property. So the LLC ownership interest itself is an asset, right? So they can foreclose on that. They can say, give us your LLC ownership. Well, of course, they get the LLC ownership. They get all the assets that are in there.
Huh.
So the outside liability, there's something called charging order protections. And what that refers to is, and it's provided by state LLC statute. And I can't emphasize that enough, that asset protection is a local game. It is state-based. It is driven by state law, and every state's got its own laws. But most states offer charging order protections, but not in all scenarios. But what a charging order says is that a creditor cannot foreclose on your LLC interest. They are limited to collecting from your LLC distributions. So if the LLC makes a distribution to you, they can collect that from you. They can be entitled to those distributions, but they're not entitled to take your LLC ownership. So that provides a measure of protection for outside liability when it applies. And it can be really powerful because here's this really cool thing. An LLC is a pass-through entity, usually. Certainly when we know with real estate investments, in most instances. Unless you're flipping, then you may want it to be an S corporation, which also has a measure of pass-through treatment. So whether or not your LLC makes a distribution, the tax implications flow through. So, right, if your LLC does make a distribution to you, you still put in your tax return every year on your Schedule C, whatever the LLC income was. So if somebody has obtained a charging order on your LLC, right, so they get the implications of the pass-through. It's like they're getting that income. And they can be liable for taxes on that. But they cannot make any decisions for the LLC, so they can't direct the LLC to actually make a distribution. So they get no cash, but they have to pay taxes on it. That's what a charging order protection can give you. That's pretty cool, isn't it?
Very interesting. So whether you are a general partner or a limited partner on a syndication, and for some way you go sideways somewhere along your process, the person or group who comes after you and gets a charge against you, they could not take the entire asset, but they could take your distributions as per your part of the investment. Is that how I'm following?
That's exactly it. They can get the distribution, but that's only if there are distributions. They cannot force the LLC to actually make a distribution. So they're entitled to the distributions if they're provided, but they can't force you to make them. So they're kind of left holding the bag for taxes without getting any money.
That's a sideways approach. Very, very interesting there. What other ninja tricks should we be aware with when providing asset protection for larger syndications?
So the thing to be aware of is, when do you get a charging order protections? When would that apply? So in most instances, that applies when there's a partnership in place. But the idea behind charging order protections Why would a state provide for that? And the underlying thought is that, hey, you may be liable and they're entitled to collect from you. However, there's no reason that should be able to impact the actual management of the LLC, which may have multiple owners, right? There's no reason the others should be guilty by association, and therefore will limit them to a charging order. Because you've got this business plan in place, this business model, you and your partners, you've got something going. There's no reason why some third party should get a role in the business because of an auto accident. So therefore, they'll limit it to a charging order. So if you're the sole owner of a business, of an LLC, most states will not offer charging order protections. Because in that case, right, what just happens is the creditor, whoever the plaintiff, he just becomes the new owner of the business. You're out, he's in, clean transition. There's no reason to provide charging order protections. But there are a number of states that do provide charging order protections, even for single member LLCs. And those are Wyoming, Nevada. So that's where those states can come into play, having an LLC in those states that explicitly provide for charging order protections, even when there's a single member LLC. So if you're a partnership, there's generally no benefit to going to those states. If you're a single member LLC, there is potential benefit. However, remember, if your asset is not in that state, how will you actually fare in court is unpredictable.
So two things, right? And for everybody listening who is doing their own syndications, it leans to having partnerships, but it doesn't lean to doing bad actions. But it's nice to know that if you get in a bind where you're involved in a car accident or something outlying that potentially was completely an accident, that you're covered on your basis for certain liabilities that may transcend into your other business practices like a syndication. So I guess that's like a warm blanket to know the answer when you get there. Hopefully it doesn't interact with anybody who's listening in any of the syndications, but it's nice to know that that's afforded as long as you have the right asset protection in place when you are doing these type of investments. So very interesting. Yeah, that we have not covered that on this show, which is remarkable. In terms of the syndication process itself, is there any, and again, this is not important, but when you have clients who come in, or maybe you're doing a split between general partners and limited partners, is there a certain asset protection type that you like to suggest for those clients?
So it's, in general, anytime you're doing these kind of things, you're going to be looking at multiple entities. So you're going to be you're going to have the asset holding entity, you're going to have the management entity, and then you definitely can layer in, a few other entities in there for either segregation of liabilities or tax optimization. But it will always vary based on the magnitude of the investment. It's really going to vary based on every single deal, and GP, and the GP's overall tax profile. But at a minimum, you're going to be looking at a management entity and the asset holding entity. But there's room for 2 to 3 other entities, based on the magnitude and the investor profile.
Amazing. So let's transition here to a few of the short form questions as we wrap this up. Tell us a little more about how you help investors prepare themselves for investing in certain vehicles.
Yeah, so we're involved. We love being involved at the ground level. The moment somebody is thinking about investing, getting them positioned to do that in the optimal way, and I say at a very reasonable cost. We advocate for keeping things simple and in a way that things can evolve with them, and based on where they're located. So unless somebody's in Texas, you're not going to hear Texas Series LLC from us. Unless you're in a state with a land trust statute, you're not going to hear a land trust from us. And these are all things that, and I've had some debates out on Bigger Pockets with some people that hawk these things. But in general, if a state doesn't have a land trust statute, there's no way to know how any judge will treat that. If the state doesn't have a series LLC statute, we don't know how they're going to treat that. Should you be an S corporation? Well, we think that's an area that is S corporations in general are over promoted. CPAs, I'm a CPA, and yes, it's great. If you set up an S corporation, I get to do an 1120S for you. So we get an additional tax return, and it's a tax return that you can charge more for than your 1040. Although I'm not inclined, ironically, I do many 1040s. 1040s are individual tax returns, which are far more complex than any 1120S that you'll ever see. But there's this thing, business tax returns, you can charge more for. So CPAs love S corporations because they get an additional return that they can charge more for. They get payroll. There's all sorts of compliance stuff that you need to get in place if you have an S corporation. And we feel there are generally many reasons not to use S corporations. So an S corporation may shield you for some payroll tax, but there are lots of other gotchas and surprises that may be lurking. But of course, they are appropriate. And I'd say one of the things that I focus on a lot is QRPs. Are you familiar with QRPs?
I am, yeah.
So QRP stands for Qualified Retirement Plan. Anytime we do, and in the real estate space, if I could toss a question at you,
sure.
What's a QRP?
So just throwing it out, but I did hear a gentleman speak about it when we were down at Jake and Gino's event. It's another way that you can invest in real estate through a qualified retirement plan. So a different type of retirement plan that would be, let's say, contrasting from if I was going to invest as my self-directed IRA. It gives me another option to invest side by side. Each have different advantages, and it's based on your retirement plan strategy.
Okay.
Not a great answer, but that's at least to the point. I knew it wasn't for me at that point. That was what I took from it, and then I put it away.
All right. If I were to ask you, have you ever heard of Checkbook 401k?
Same person has spoken the concept, yes.
Yeah, okay, solo 401k.
Right out to do at your point. Solo 401k, same advice here. You can basically invest as you want using your 401k, be able to predict your type of investments and not be predicated to whoever is running as the, not signatory, but as the advisor for the 401k.
All right, if I were to ask you, is a solo what are the distinctions between a solo 401k and a QRP?
Now you're putting me on the spot. Now I'm going to go back to the professional.
Okay. So here's the surprising thing. That was a trick question.
Sure.
They're the same thing.
Okay.
The QRP stands for Qualified Retirement Plan. And of course, technically, any type of qualified retirement plan can be used for real estate investing. And a qualified retirement plan refers to 401k plans, defined benefit plans, defined contribution plans, KEO plans, profit sharing plans. Those are all types of QRPs. In practice, anybody that's advocating using a QRP for real estate is using a solo 401k. There are just different ways, different terminology to use. Now, they are distinct from self-directed IRAs. We offer both checkbook IRAs and checkbook 401ks, and we're very careful not to shoehorn anybody into a structure that doesn't work best for them. So the QRP 401k is the preferred structure if you qualify for it. If you don't qualify for it, you don't want to touch it. Because getting into something that's not a good fit is just not you don't want to go there. The tax implications are not good. Now, here's something really cool about QRPs. Your annual contribution limit to a QRP is technically, it can be close to $60,000 per year. So that's really powerful. You can get $60,000 tax deduction from having a checkbook 401k, QRP, whatever you'd like to call it. But how can you maximize your tax deduction? Well, that will depend on how your entity is taxed. If you're taxed as a disregarded entity, meaning there's no S corp election, well, then your annual contribution limit, your annual deduction, is based on your total income. If you're an S corporation, which means to say you've got to pay yourself a salary and issue yourself a W-2, your tax deduction is going to be based on the amount that you pay yourself on a W-2. Now, when you set up an S corporation, the general reason you're going to do it, your CPA is going to say set up an S corporation, is so that you can pay yourself as little as possible. That's the idea. Now, the IRS knows about this game, and they say you've got to pay yourself a reasonable salary. But the idea is, and rather than taking everything as profit, that you take a portion of it as salary. And that thereby you save yourself payroll taxes. You save yourself what's called self-employment tax. And that, so you're going to look, if you're going to pay yourself, if you need an S corporation, your CPA is going to say pay yourself as little as possible. Well, here's what happens. Here's one of those unintended consequences. And I'll bring up the contribution calculator that we've got on our website. That's at 401kcheckbook.com. And I'll just plug in a number. So say you're, say you have a choice. You can take $40,000 as salary. You make $40,000. Let's bring the numbers up. You make $100,000 in your business. You can take that $100,000 as a sole proprietor, pass through, disregarded entity, or you can pay yourself a salary of $35,000 and take the balance of $65,000 as profit. Well, what's going to happen to your tax deduction? So if you're taxed as a sole proprietor and you're making $100,000, you can get about $40,000 in tax deductions using a Checkbook 401k. If you switch to being an S corporation and you pay yourself $35,000, then your tax deduction drops down to about $27,000. So you lose about $13,000 in potential income tax deductions by being an S corporation.
Interesting. So
there are so many moving parts, and I get so many people say, okay, Bernard, I had my, I know you focus on, you're a Checkbook 401k expert. I'm having my entity set up by LegalZoom, by some internet guru, and they said I should have an S corporation, and now I've got the S corporation, and now I want to get all the tax deductions possible using a QRP. And they also taught me that I can pay myself as little as possible, and that's I'm going to maximize the strategy. So I set myself up, I'm making $100,000 per year, and I'm paying myself $15,000 in salary. What's the highest deduction I can take? And I'm like, I don't know how to break this to you. If you would not have this structure in place, you can get $40,000 in deductions. Right now, you can get about $10,000 in deductions. So there are so many moving parts, and you need a centralized place to get you set up where they have this repository of expertise in all these areas to make sure you get all the moving parts addressed without any unintended adverse consequences.
Well, this has been incredible. So thank you for this. And we've come up on time, but there's so many different ways we can go. We'd love to have you back in the future to talk maybe more about a specific opportunity. But in regards to anybody listening that would like to reach out and talk to you more in depth, more particular to maybe their strategy or their case, what's the best way to connect with you?
Best way, first I'd say, is visit 401kcheckbook.com or agentfinancial.com. So that's 401kcheckbook.com and agentfinancial.com. Lots of information there. There's a scheduling link there. They can schedule a quick 15-minute introductory call just so we can talk, see what they've got going, and kick things off.
Amazing. Bernard, this has been incredible. Thank you for sharing all your wisdom on this.
Jason, great to be with you. So glad to be on the show, and I definitely love to be back.
Definitely. Well, this is Jason with the Real Estate Investing Foundation podcast. Very grateful to have Bernard on the show. Really gave us some awesome knowledge we haven't tackled on before. Thank you for listening. Thank you for everyone out there tuning in, and talk to you shortly. Bye now.
Thanks for tuning into the REI Foundation podcast. Check back next time for more awesome tips and strategies to launch your new you in real estate.